Hi, this is Don Gooding with the 4 Colors of Money for Entrepreneurs. In this video, we're going to talk about the question, are you ready for equity investment? And if you're not quite ready, point the way to some of the next steps to help you get ready. So, like a lot of questions, this one leads to even more questions, and we're going to talk about 5 different questions. So first of all, are you sure that equity is the right kind of financing for your business right now, as opposed to the other 3 colors of money, those being bootstrapping, grants, and debt? Secondly, are you sure that you've achieved business model validation? Because that's something that a lot of investors want to see. Third, have your business metrics reached the point that they're showing momentum? And that's another thing investors want to see. Fourth, are you ready for the grueling 6 to 12 month fundraising process? Most entrepreneurs actually aren't. And then finally, are you sure that there are investors who are ready for you? Because it turns out most investors specialize in different industries, stages of development, and geographies, and you got to make sure that there are investors who are ready for you before you start this process. Let's dig into that first question, is equity right for you now? The reason to ask this question is, first, equity is actually the most expensive form of capital if you are successful. And second, of all the companies that try to seek equity financing, only a small percentage actually get it. So you want to think hard about this question, and I've written a separate piece on equity versus bootstrapping that asks 19 questions, and I'm not going to go into all of those now, but instead I want to highlight the top 3 issues to consider. So first of all, do you have access to other cash from bootstrapping, grants, or debt? Those other 3 colors of money are cheaper, and so if you do have access to them, usually it's the right choice to go for those first. Second big issue is your business industry product dynamics, and I'll get into those in a minute because sometimes those push companies towards equity. And then a third big issue is, are you a fit for equity investors? So let's look at the second question, your product industry business dynamics. A couple things to consider here. First of all, some companies have a very long and expensive product development cycle, and that often pushes them towards raising equity in order to get the product developed. Drug development is a classic example where it takes many, many years and many, many millions of dollars to actually get the product to the point that you can sell it. So drug development companies are often forced to raise equity. So think about your own product development length and dollar size to think whether it's forcing you into the equity fundraising process. Second thing, in some businesses, the sales cycle or the business development cycle is long and expensive, and again, that forces them into equity fundraising. Selling software or software as a service to very large corporations is an example where it can take a long time, and you're trying to get these big corporations to finally say yes to these large ticket items. Again, those kind of companies get forced into equity fundraising in order to survive the long sales cycle. And then finally, there are some industries where there may be a lot of competitors initially, but over time it boils down to just 1 or maybe 2 dominant players, often because of so-called network effects. Facebook, LinkedIn, Google Search are classic examples where network effects, customers all wanting to be on the same platform, have led to one company becoming dominant. And so if you're in that kind of an industry, you need a large equity fundraise to market and win the battle for dominance because there will only be one. So you have to think about your industry dynamics to see whether or not equity is something you're going to be pushed into. Final question to ask is, are you a fit for equity investors? Lots of questions here, including, can you share control? Are you okay selling your business in 5 to 7 years? And then from the investor's perspective, is yours the kind of business that can grow its value, its worth, by 50 to 100% every single year for the next 5 to 10 years until it's a very valuable corporation? That's a great fit for equity investors, and most businesses don't in fact fit that. So in sum, you have to ask the question, is equity right for you? And if you finally get through all these questions and answer yes, that is the beginning of being ready for equity investment, but that's just the start. The next question to ask is, have you achieved business model validation? So Steve Blank, who is the #1 entrepreneurship educator in Silicon Valley, he's done a lot to tie business model development, the business model canvas, to startups. And there are hundreds of accelerators all over the world who are helping startups to make their business model development, their customer development go faster. But Steve Blank wasn't satisfied. He wanted to be able to measure these hundreds of companies to say, are they actually ready at the end of this process to get to that next level of investment? And so he looked around and he was inspired by the technology readiness level that was developed by NASA, the U.S. Space Agency. And so he's developed an investment readiness level that ties in the sequencing of working through the business model to get to business model validation and finally to achieve an actual investment readiness level. I encourage you to look at the Steve Blank video that talks about this sequencing, but I want to highlight just a couple important things. First of all, as you start to achieve business model validation, you're starting to get ready for the next level of investment, but also to leave behind the business model canvas as your primary tool for figuring out where you are. And as you can see, when you get to the top of the investment readiness level, the focus is now on metrics that matter. And so these metrics are actually going to become a part of the dashboard, if you will, that are going to replace how you're looking at your business and how it's ready for all sorts of things as opposed to the business model canvas. As you start to get towards business model validation and that next level of investment, those investors are going to want to see momentum in your metrics that matter, especially if you're trying to get a Series A investment. Now, those metrics are going to vary considerably from industry to industry. So manufacturing, online retail, consumer apps, and software as a service targeted to enterprise customers, those are going to have very different key metrics that matter. But in general, they fall into 3 general categories. First, there are financial metrics. Secondly, there are customer or unit economics metrics. And finally, there are metrics that help predict what those customer or unit economics are going to look like in the future. So let's dig into the first bucket. So financial metrics, you can start and more or less end in the early stages of development with the top line and the kind of middle profit line leading to the bottom line. So revenue, and if you're in a software as a service or other kind of recurring revenue model, monthly recurring revenue. Those are numbers that obviously investors are going to be looking at to try to see if you have revenue momentum. So they're going to be looking at compound growth over time. The problem, of course, is depending on your business and your stage, the amount of time and the amount of compounded growth that they're going to be looking for is going to vary considerably. Needless to say, if you're looking for tens of millions of dollars, you have to have a lot more momentum than if you're looking for a much smaller amount. And then in terms of profits, there's a lot of attention paid to your gross profit margin, and that will also vary considerably from industry to industry. In software as a service, generally because the margins are so high, there's a little bit less attention paid to the momentum there than, say, in manufacturing or online retail, where achieving overall bottom line profit is highly dependent on momentum of increasing your gross profit margin over time. So that's the first category. Now let's move on to customer or unit economics. Again, it's going to vary quite a bit depending on the industry, but especially in the tech industry, average revenue per user is one of the metrics that is looked at quite closely, trying to break down overall revenue into what it means for individual customers. And then also related to that, CAC, customer acquisition cost, is another number that's focused on quite heavily. And then finally, taking the average revenue per user and turning that into a lifetime revenue, lifetime value of a customer. You put all these together because investors want to understand, are you acquiring customers for a cost that is significantly less than the value of those customers over the lifetime? Because it turns out, unfortunately, there are a lot of businesses where it's so expensive to acquire customers, it's actually not overall profitable over the lifetime of those. So again, depending on your industry, it's really important to figure out those customer or unit economics to make sure that over the long term, you're going to have a profitable business, and especially that the momentum is towards having a business that's going to generate lots of profit, at least in the future. In the third category are numbers that help to predict the future customer or unit economics of your business. And of course, you have to be showing momentum in these as well. First of all, overall number of customers or users, how is that number increasing over time? If you have a freemium model, showing the percentage of paying versus non-paying customers is also important to show that there's a likelihood that you're going to get a higher percentage of people paying to use the product over time. A net promoter score that is improving over time. If you don't know what net promoter score is, make sure you look that up and track it. Following your churn, or the flip side, retention of customers, is important. Investors want to see that your length of relationship with customers is going to be increasing over time, which then should lead to more opportunities for monetization. And finally, depending on your business, the viral coefficient, or the time that users are spending actually using your product, both can be indicators that in the future you're going to have a great opportunity to monetize this great product that you've developed. To bring it back to the original question, does your business have metrics momentum? First step is you have to measure the metrics that matter. And then you have to be able to show investors that without their money, you've been able to build momentum. And so with their money, you're going to be able to increase the momentum in the metrics that matter. And that is yet another way to show that you are ready for equity investment. So if you're sure that equity is right for you, your business model is showing validation, and your metrics that matter are showing momentum, you're still not ready for equity investment if you're not ready for the grueling 6 to 12 month, 12-step equity fundraising process. And unfortunately, a lot of entrepreneurs aren't ready. they think that if they do a lot of work on their pitch, they're going to give a great pitch and that'll lead to investment, right? Unfortunately, if you look at this list, pitching is only step 4 out of the 12-step process. Now, I'm not going to go into all 12 steps right now. In fact, we do have some other videos that detail all 12 steps, but I just want to highlight due diligence and term sheet negotiation as 2 steps in the process that are critical. They are unfamiliar to most entrepreneurs, and they benefit from a lot of preparation, a lot of homework. So until you've done your homework and your preparation to get ready for due diligence and term sheet negotiation, you're actually not ready for equity investment. One other note, this process is the least favorite part of being an entrepreneur for pretty much every entrepreneur I've ever spoken to. So you also have to be psychologically prepared, not only for a challenge, I mean, you're used to having a challenge, but having one that just is no fun. Then you'll be ready for equity investment. There's one more way to think about the question, are you ready for equity investment, that I want to touch on for a minute, which is to turn the question around and say, are there equity investors who are ready for you? Now, I started my career with Accel Partners a long time ago, and I've had exposure then to Silicon Valley style investing. But then for the last 20 years or so, I've been in the little state of Maine, little in terms of people, large in terms of geography. And that's been a developing early stage equity marketplace. So I've got kind of good news and bad news. The good news is that all over the world, there are lots of investors who are realizing that high growth potential companies are a great place to invest at the early stages. The bad news is that it's not fully developed as it is in Silicon Valley. And outside of the top 20 global tech hubs, 12 of which are in the US, it's pretty scattered. And it takes a long time for these markets to develop. So you shouldn't assume that there are going to be investors who are ready for you. And so before you go and do all the work that I've been recommending to get ready for equity investment, you want to make sure that there are some investors who are ready for you on the other side. A thing to keep in mind is that lots of different investors all have some kind of specialization. That's just like you have a specialization in your business, so too do investors. So they invest in specific geographies, in specific industries, in specific stages of development, and in some cases in specific kind of investment vehicles. So for example, you have to check out in your country, in your location, are there investors who are doing, in general, early stage investing? If you're a tech company, make sure that those investors are comfortable doing tech versus non-tech investments. If you are an early stage company, make sure there are investors who are comfortable at early stage versus later stage. And finally, make sure that there are, in fact, investors who are comfortable doing the kind of equity preferred share investing that is common in Silicon Valley and lots of other places, as opposed to doing a debt instrument if it's equity that you think you really need. So make sure you do your homework there to make sure that after all of this work that I've been talking about, there's actually somebody at the other side who will be able to write that check for you. So now that you've had a chance to think about these questions yourself, it's time to talk it over with your team and your mentors. This question of, are you ready? Are you really ready for equity investment? So have you gone through equity versus bootstrapping and answered those 19 questions to convince yourself that equity really is the right choice for you? Are you sure that you are approaching at least business model validation? Do you know what your metrics are that really matter to your business, and are they showing momentum? Are you truly ready for the 12 steps of equity fundraising? And are you convinced that there are, in fact, some equity investors that are ready to write you a check for your kind of business, your stage of development, where you are when you're through all of this process? And if you're not totally ready, no worries. That's what this program is all about, to help you get ready for equity investment.